Okay, welcome again, brothers and sisters, from wherever you are tuning in. People from the UK, welcome, Karibu. From the US, good morning if you're waking up. Good afternoon. But nevertheless, you're welcome. So today, I'm going to walk you through what I call a trading. But in particular, I will share with you my trading plan. Okay, so I'll share with you my trading plan so that you can also try in one way or another, uh, imitate or make a copy of it or learn from it. Because what we are doing is not rocket science, but it is something that has become the norm, especially for many people in different countries. So for us, we are deciding, well, we want to be traders. Hopefully, at some point, maybe even become professional traders. But for that to happen, we must um, have consistency. In other words, we need to be profitable. And to be profitable, it means we must have learned the trade to be able to repeat what we're doing over and over and over and over. Okay? So it is the repeating, the ability to repeat over and over and over is what makes us successful. That is what makes us a success. So then the question is, then how do we get to a point where we are successful? How do we get to do that? Well, that is why we are talking today. You become successful when you have learned the arts of doing something over and over and over and over. But how do you do something over and over and over and over and over? You get to do something over and over and over when you have a plan. So essentially, what we're talking today is then how do I make a plan? What is it about? Well, I'm glad you asked because a plan is basically what it says, a plan. It's like, okay, I'm going to trade today. So what do I do? Do I just get to the market and take a bunch of sells and buys? Oh, the market is going down. Fine. Let's take a sell. Market is going up. Oh, fine. Let's take a buy. Is that what we do? Well, if it was that easy, everybody by now would be a millionaire. Okay. Unfortunately, it's not just taking a buy and taking a sell. Well, in theory, that's what it is. We are doing buys and sells in the market. But more importantly, we have to have thought process. We have to plan. We have to have thought and execute that thought with a plan. Okay. And that's what we are doing today. So, having said that, most successful traders do have a plan. And today I'm just going to share with you what my trading plan is. Okay. Um, the good news is the trading plan doesn't have to be something elaborate because nobody's going to check you. Nobody's going to check you and check on you on what your plan is and how you do it. No, 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 no. You will know yourself. You will know if you are executing your trading plans or not. Okay, and basically the trading plan will also tell you whether you are being profitable or not. All right. So you need to have a plan. So what I will do, I will first, as a proof, share with you that I do have a trading plan. Okay. I will share with you what I have, but more importantly, I will also walk you through my trading plan. So let me see if I can just a book, not a textbook, but a book, a notebook. So again, like I said, it doesn't have to be something elaborate, like. So before I try and project it, I don't know if anything can be seen from there. Let me see. Is it even visible?
It is visible.
Mhm. Okay. Let me see if I can. Okay, this is my book. Okay, that's my book, as you can see. Sorry, I'm going to see if I can project something. That's my book. Okay, and here, if you look, I have a lot of, I call it chicken handwriting. That's chicken handwriting, if you can see there. Well, that's my handwriting. But what I've done, I have handwritten, and I've handwritten this at the back of my book. This is my hardcover book. Okay, and behind there, I have handwritten everything. But please note that I have tried to make it all in one page. Everything in one page. Okay. A trading plan doesn't have to be sophisticated. Doesn't have to be, like some serious things. No, it is just a simple plan. So I'll walk you through this. Okay. I'll see if I can project it there. And then this is my old plan. Okay. The plan is a live document. You try to work and live with it. So in my old plan, again, you can see, again, it's my chicken handwriting. So don't worry if you can't see, because that's not the idea. The idea is not for you to copy mine. The idea for you is to actually learn from what I have put down. All right. So now you see I have a plan. So now I'll go through it. So I'm assuming that you're actually taking notes, or at least you're trying to learn something, hence trying to write what I will be going through. I'll see if I can project one or two things. So for that reason, let me see if I can use my phone to project. Oopsie. Sorry. Yep, I think I will be able to project both of them. This one and then that one. Okay. All right. So in 1 second, I will be able to project. But in the meantime, as I'm projecting, it's my hope that you have been trading, but at least have an idea of what you want to do in the market. So on a given day, you've heard how other people say, "Oh, I don't trade on certain days." Okay, that's their plan. Certain days they don't trade, which is fine. Um, while others trade every single day. But if you have a plan, then you don't have to worry much about that, unless your plan includes that aspect. Okay, so I'm going to upload something here quickly. So my first plan. So it's coming to your phone, but I'm gonna, okay. All right. So I'm going to project so that then we are all on the same page. Mm, Okay. So, all right. Are you able to see that?
Yep.
Can you see that?
Yes.
Okay.
Yeah.
It's clear. Okay, good. So that's what I'm gonna walk us through. Okay. So this is what I call my daily trading plan. Oops. I'm trying to zoom through it, but it's not allowing me to. Okay. Okay. So on the heading, by the way, your trading plan should not even be typed. It should be handwritten somewhere in your book where you can access it, okay? Where you can actually handwrite it, and as time goes by, you can keep revising it to make it better and better and better, okay? So this one I think was my last year's trading plan, okay? And you even write what it is. So you write your name and whatever you want to call it. So I call it Tom Okore Trading Plan. All right. Now, the first thing you want to do, and again, I'm going to do this based on the way I trade. So you can take this and adapt it to your style. So first thing I have to do, I have to decide what time frame I want to trade. Okay. By that I mean the charts. All right. So for me, the time frame, whereas I trade on a lower time frame, I use the daily, okay, and 1 hour. So as you can see there, I use daily and 1 hour to confirm the general direction of the currency pair for the day. So if the daily is actually, well, normally you'd see something like this, and then the next one, and so maybe it's still forming. So clearly you can see, we can assume that this market is going up. So this is the bias. So this could be the daily, okay, daily time frame, daily. But when you look at the 1 hour time frame, the 1 hour time frame may be something like this. Okay, so it means that yes, it is still going up. That's 1 hour. And then the 1 minute time frame, now that is where I trade. So I use the daily time frame to get the general direction and confirm it using the 1 hour. Then I use the 5 and 1 minute to do my trading. So time to trade, okay, before I get there. So the 1 hour would actually be a lot more volatile, you know. So it provides many opportunities to go in and go out, go in, go out, go in, go out. All right. So generally, you find that time to trade during the high volatility, for me, that is when my scalping becomes alive. Because during the high volatility, which happens during London breakout between 8 a.m. and 10 GMT, okay, between 8 and 10. That's a lot of volatility at that time because the London market has opened at 8 and the banks are moving money. And so if you look at the market at that time, there's a lot of action, there's a lot of volatility, you know, going up and down and so on. I mean, of course, not literally like that, but you'll see, if you look at the 1 minute, you'll see it moving a lot. Okay. And so to me, that is the time to trade because of my strategy. Um, the next thing is indicators. Now, again, like I said earlier, this is my style. Your style, if you're using indicators, okay, it might be different. Okay, so uh, the market condition, no, here, indicators. For me, the only indicators I use are just the price action. In other words, I look at the charts and that's how I trade. I look at the charts and make decisions based on what I see. And that's what I call price action. And I use heavily support and resistance zones. Support and resistance zones are critical for me. Okay, without that, I cannot do my trades. Okay, and I would hope that for many of you, that would be a telltale sign. So the only indicators I use is price action, which means I'm not using anything. I'm not using all these other indicators they have in the platforms. Why? Because I have trained myself to use those tannings. See, the market always goes like this, for lack of a better word, it goes like that, like that, like that, like that. Okay? So for me, it is this tannings, this, uh, sorry, those turnings, those are the ones that I take advantage of. When the market is going down, okay, I draw a line. I draw a line each time the market turns because by doing that, I can figure out, I can almost tell where the market will be turning because I know where it's going and where it's coming from. All right. So I use support and resistance. Now, um, and of course, we've talked about that before, how to set up your support and resistance, the charts. Then currency. What currency do I use? Well, I could use very many currencies, but I choose to use Euro USD. Only Euro USD. Why? Because for me, Euro USD has some of the lowest spreads, and even most of the brokers, uh, because of the movement of Euro USD in terms of volatility, most brokers actually have a lower spread on Euro USD. So that's why I use Euro USD. Plus, it is also the most liquid currency in the world. Rather, yeah, liquid pair. Most liquid pair is Euro USD, which means that there's a lot of volume being pushed into the market um, on the Euro USD pair. All right, market conditions. All right, at market conditions, again, I have certain things I look for in the market. You know, uh, which means that if they're not there, then I will not trade. First, I have to understand the story. I have to look at the market and see, okay, what is the market doing right now? Okay, is the market, is it on a reversal? Is it, is it going down? Is it, so when you look at the 1 hour or, so if the 1 hour seems to be going down, okay, that was the last high, and this is the next low. Remember, it just finished, it just turned over there. So I'm suspecting this market will actually be going down to try and rally over there. So this is in a 1 hour. So when I go, I normally put my last two charts, I normally put the 1 minute on the left, and then I put the 5 minute on the right. But the 5 minute, I just want to know the direction that's going. So I know that the 1 hour,
Uh,
you have a question?
yes. So,
Ooh, now you can.
Anaibutu, what you're explaining.
Can you see?
We're unable to see it yet.
Oh, okay. All right. I'll draw it on the right hand side. Okay. What I was trying to say, um, I use the daily chart to kind of figure out the direction, the general direction. So I tried to show you a picture earlier that if you were to draw the candles, okay, and on the daily, you see that the candles are actually going up like that. And so when you are starting to trade, you see like a little thing like that forming. So it means that the daily is still being formed, but generally you know that the general direction is up there. Why? Because maybe the last high was somewhere there, and maybe it's coming from a low which is somewhere there. So because we know this is going up, it means that the 1 hour should give me a clear picture. This is daily. Daily. The 1 hour should give me a more detailed. Okay. Yes, William, you have a question there.
Yes.
Do you have a question? Okay, I see you. You raised your hand. All right. I will look at the 1 hour chart. If this is a daily chart, so the 1 hour chart will be something like this. Okay, it will be more detailed than the daily. Okay, which means that the 5 minute chart or the lower time frame will even be more pronounced. It's going to be a lot of that. Okay, okay, so it'll be more pronounced. You'll see a lot of series of ups and down, ups and down, ups and down. All right. So to me, I have to understand the story. Okay, which means the market is on an uptrend and it's rallying to go back to the last high. That's the story. It came from down there. I'm not seeing any, by looking at the charts before that, I'm not seeing any near support or resistance, something that will block the chart from the market from rallying back to the last high. That's the story. Okay. I don't see if there's any news happening today, or if there's going to be some news and the market was somewhere up there, then I have to be aware that if there's news, then this thing might hit the top very quickly and turn around. Why? Because it's already up in the uh, last resistance point. Okay, it's almost up there. But if it's up here, then that is okay. But if it's up here, yes, even though I'm trading on a buy, I know it's about to hit the last high, and very quickly will start turning backwards, turning to a sell. So that is knowing the story. You need to know the story. Okay. Uh, I always look for high volatility. Okay. If I see market just playing around, not moving, okay, the market is just around there, not moving much, then I cannot enter my trades because it's not really moving much. Okay. But if I start seeing a lot of up and down, and then up and then down and then up and down, then that is good. It's good for me, all right, for my trading. This kind of market is dangerous, at least for my trading, scalping. All right, I will look for markets with high momentum. Again, momentum is almost synonymous to volatility. Momentum, you see markets that are moving, then they come down, then they move, then they come down. Okay, when there's high momentum on this long movements,
Tom.
yes. Oh,
No, this is Mark. Sorry.
you can't see on this side, eh? When I'm
Yeah,
when I'm
you
writing.
can see on that side.
Yeah.
Yeah.
Okay. I just keep forgetting. All right. So on the right hand side, something is wrong. I'm not able to project on that side. Anyway, so I look for to understand the story. High vol.
Change the background.
Eh?
It is gray. See, the background of the one on the right hand side, it is grayish.
It's
So
gray.
the one on white.
Yeah.
So probably what you're trading just in the background. Maybe
Okay.
you change the color.
Okay. But it's a bit late to try and figure that out. I think it's something in the computer, not out here. All right. Then the next thing I do, okay, market conditions. I will never trade. Okay, again, this is when I'm doing scalping. I'll never trade in the current market direction. Now that's a bit controversial to other people. Okay, but let me explain what I mean. For me, because I'm doing scalping, this is what I do. Okay, it goes down and then probably goes up and then goes down and then goes up. So as you can see, oops, again, I keep forgetting. I need to come back on this side. All right. So the markets go like this, and then come down, and then like that, and then come down, and then go like that, and then come down. All right. This is when it's trending. So when it's trending, it's an easier way of looking at it. But at the very time that the market is moving up, okay, when I know it's going to come down, if it's trending, I kind of have an idea of where it's going to touch. So my goal is to make sure that, okay, these lines, I have them mentally figured out where they are, okay? So when it's going up, I kind of have a mental picture that there is a point there that's supposed to be some resistance. Then I start doing my selling just before it turns. It's going up, but I'm selling before it turns, all right? Now, the reason for doing that, for me, is to increase the probability of actually taking those profits. Because when it reaches there, the market will be trying to come down to retest the last low. So the market has a higher probability now, for me, it has a higher probability for it to only reach up to there, up to that level, or up to maybe 50%, than to go all the way down. So by the time it's coming down, I'm already taking my profits. Why? Because I'd already set up my sales, sell. So I'm taking my profits as it comes down. All right. As it comes down, when it's almost reaching down there, okay, then I start doing what I call a buy. I only do that again if I know I'm on a trending market. I start buying. I start buying at that point, there, there. All right. So I probably put like three, and this probably will be like on a smaller, what do you call it? On a smaller time frame, you'll see that this is more like a support or resistance. Then as it goes down, it's not support or resistance, and this is another support. All right. So I'm just not taking trade just because I like to or because I want to. These are actually significant turning areas in the market. Sometimes it will come there, then it will hold a little bit, and then it'll continue down, and then hold a little bit, and then go down completely. So for me, as soon as it gets there, I start doing my buying. Then I do my buying. Then I do my buying. And then by the time it turns, then I'm in those trades as we go up. All right, so that is my point. I think point number 3, 4. All right. So I've done market. Okay, we never trade market direction. Then there's something I wrote there. I will use wobble technique if market runs against me. That's a technique that I've learned over time. It's a very powerful technique, and I don't know how I can explain it. In brief, what it means is you start doing counter trades to try and make up for the losses that you might be experiencing. Okay, so counter trades or trades, um, you start taking heavy trades and counter trades to try and make up for your losses if you're starting to experience losses because the market is going against you. So if the market is going against you, then you quickly start pulling down their profit targets, so you take lower losses, and then you start taking counter trades. But that I can only show you when we're in live market conditions. So now I can only explain to you. All right. Then the last point in my trading plan is about risk management. All right. Basically, you have to ask yourself. There are things I didn't write there, but I'll just share with you. One, I do not trade more than 0.02. Very, very rarely. I often do 0.01. Okay, that's number one. Number two, my risk, my level, uh, not risk, but lot size. My lot size very rarely again goes beyond. Okay, that's a lot size 0.01. But the leverage, yes, the leverage, I always trade 1 to 100. I very rarely do worse than that. Where worse than that is more riskier. So if you do 1 to 50 or even 1 to 1, you can blow your account very easily. Okay. So when you are learning, you could do 1 to 800 or 1 to 1,000, but 1 to 1,000 to me it's a bit unrealistic. Okay. So 1 to 100 is a bit realistic because you can almost relate, pips to dollars, pips to dollars. And that's why I keep telling you, when I trade, the equivalent for me normally is 1 pip. Okay, 1 pip is $10. That's the equivalent. Okay, but then the other variables come into play. Okay, so I do make sure that my risk management is up there. Then I also decide that if I am losing, if I start losing and I reach 5% of my account, that's it. I'm done for the day. Okay. I have to be out of the market for the day. And that one has been preset by my broker because that's the strategy they use. If you start, losing and the market suddenly shoots, okay, you have set a system so that if you lose more than 5%, you're done for the day. So assuming you're a small account of maybe 1,000, so 5% of 1,000 would be what? 50? Yes. 5% would be 50. So is it 50 really? Wait. I know we have mathematicians here. They're not helping me. 5%.
It's 50.
Yeah, that's correct. All right. So if I have a $1,000 account and I lose 50, if I lose 50, that's an extreme, by the way. I'll never let it go that far. But in the event the market just decides to do weird things, at 50, I'm out. I'm out for the day. But usually I manage it and control it so that I very rarely go to 1%, because I'm always looking for profit. So I don't want to lose anything up to about 1%. So in fact, I minimize my losses. So if you look at my trades, when I do my trades in a day, you find that on average, if I do like 100 trades, chances are I've probably won all the 100 trades. Maybe there's one or two that was a problem, but yes, I try to make sure that I win all of them. Which is not to say that I have a 99% winning rate. No, but I like to keep a very high winning rate uh, because with time it then reflects on the money that you're making with time. So try and keep a very high winning rate. For every trade you take, you want to win. If it's going to be a loss, then you minimize the losses. All right. So I think in my next or updated plan, I've put a bit more detail there. But in general, that's a trading plan. Now, why is it not typed? Because it's not supposed to be typed. Why is it looking funny in my handwriting? Well, because it's supposed to be something you plan to use daily. It's just your handwriting. Okay. Why doesn't it look sophisticated? Because it's not supposed to be sophisticated. It's supposed to be very simple, something very simple. So I can almost say that my trading plan has about, 5 points, 5 or 6 points. One, the time frame that I trade. Two, the time I trade. Three, the indicators that I use. Four, the currencies or the currency pairs that I use. Five, market conditions under which I will trade. And six, my risk management. So yours can be something similar. It doesn't have to be the same, okay? But that's the idea. So this is an improved version of the first one. Again, my handwriting probably a little more straight instead of the first chicken handwriting. I think the first one I was doing like 3 a.m. in the morning one night many years ago, about a year ago. So this one is a revised version of the same. Again, it's my trading plan, handwritten, time frame. You can see daily, 1 hour, 5 minutes, and so on. And then I explain. I use daily and 1 hour to determine the general direction of the day. Then time to trade during high volatility, during London breakout between 8 and 11 GMT. 8 and 11 GMT. Why? Because the London market opens at 8. And to me, the first 2-3 hours are usually the busiest. The first 2-3 hours, and I want to take advantage of that time. Then around 12 noon, most traders go for lunch or whatever. They are big shots. They don't have to stay there till 1 o'clock to go for lunch. But it's been known that many banks or whatever financial institutions, they slow down around lunchtime. So UK lunchtime, the markets slow down. Then they become alive again at 1300 GMT. Why? Because New York is opening. New York opens between 13 and 14, depending on the season. And the combination of both, the London and New York, makes the market very busy, extremely busy. Yeah. So I know that for the London market, 10 o'clock is almost like peak, 10 GMT. For New York, the peak is about 14 GMT, 14 as you go 15. So that's when you see probably the highest movement. Then the indicators I use, like I've shared before, I don't use any indicators, but I use price action. Okay, I use support and resistance zones. So basically, I just wait for the market to go to the zone up and I sell down. If it goes down and I sell up. If it goes up and I sell down. If it goes down and I sell up. I mean, buy up. And that's it. That's how I trade. Currency. For now, I'm only using Euro USD. Why? Is there an advantage of using only one currency? Well, there's advantage and there's disadvantage. Other people say you're risking too much by putting it all in one currency, which I kind of agree. But the flip side is, over time, I've learned the behavior of Euro USD. In a way, I kinda know what it's about to do. I can almost say, aha, this move I've seen before. When it does this, I know what it's about to do. So you kind of learn its habits, its traits, and that's why I only focus on one. Which is not to say that I don't or cannot trade other currencies. Yes, I can. I think I also like GBP USD. I like Euro JPY. Okay, like Australian USD. The next phase of my trainings with you, I will introduce the other pairs and how I trade them, because I also do scalping. Okay, not scalping, but I do like sniper trading, which is basically the same breakout tradings that I showed you last time. Okay, I will do that. And then the market conditions. Again, I've revised the market conditions. They're pretty much the same. I need to understand what the market is doing. I should be able to narrate the story that the markets now have reached the top. there's a support resistance there. So the buyers and sellers are fighting now. There's a bit of, but once there's news or there's something going on in America, then maybe the dollar will probably go down. As it goes down, maybe the euro will probably increase in value because then it's considered safer than the dollar. Okay, and because of that, the charts might go up, or might continue going up. Okay, I will look for high volatility as a trader. I will look for markets with high momentum. I will enter trades in current market direction at the beginning of a move or against the market direction if it is on a pullback. Okay, and there I try to explain exactly what I mean by my pullback. Okay, if the market on the left, if the market is going down on its way as it pulls back up, can't get the marker. Anyway, I'll use this. So again, like I said, I was just trying to explain that as the market goes like that, like that, like that, like that. Okay, so as it's going down, every time it tries to go up, I'll be selling. Every time it tries to go up, I'll be selling. Why? Because I know in general it's going down. All right. So that's my strategy. Let me see. Oh yeah, this one was spilling over to one more page. But again, it's not very clear there. But if the current market runs against me, I will start using a wobble technique. I'll have to show you what that is. Again, that's a technique. That's not a strategy. It's just a technique. It's something you can do when things get very bad. All right, you do counter trading. All right. Then there's risk management. So in the risk management, I say that I only make my trades decisions at support and resistance levels. Okay. And when I take my trades, I only shoot for a 1% return. And then I end my trading after earning my 1%. That's my risk management. All right. Now you can ask questions. Oops. We are open to questions unless this was very simple and very clear.
Hi.
Hi.
You can explain the difference between on leverage, the difference between an account that has a leverage of 1:100
Mm-hmm.
and one that has a leverage of 1:, maybe 400 or 500 or 1,000.
Okay.
Yeah.
All right. So let's start with 1 to 100. Okay. So the simplest way I can explain this is if you have a $1,000 account, okay, your account, for lack of better word, because this is 100, again, I'm using a very, very simple watered down example. We can pretend that for every $100 you have here, okay, your $1 okay, will push $10 there. Okay. All right. This might be a bit what do you call it? A bit okay. All right. Let's look at maybe 1 to 50, so that we have 1,000 account. So this time, if you divide 50 by 1,000, 50 by 1,000, you get 200. So your $1 here, can you see? Yes, your $1 will push $200 in the market. Okay, and as the level goes even lower to maybe 1 to 5. Wait, was that 200? No, that was 20. Yeah, this was 20. It's not 200. Sorry, 20. All right. So 1 to 5 is 200. Okay. And by the time you're actually saying you're doing 1 to 1, it means that you are so confident that your $1 will actually push 1,000. Now, here is the flip side. The risk is when you see this, to move the $1, maybe just a few pips, maybe whatever pips. So it means that similarly, to lose 1,000 for you with a risk like this, 1 to 1, is very easy. Your account will be wiped out suddenly. Why? Because this is considered very risky. You don't want to do 1 to 1. In fact, I think in the US there's a law you can't even do 1 to 5. 1 to 50, I don't know, but that's considered very risky. But the people who actually do it, some of the brokerages that are outside the US and other developed countries, they say, no, it's okay for us. You can have, but what they do when you come to a demo, they tell you it's okay. You can do 1 to 100. You can do 1 to 200. You can do, so the 1 to 500. Okay. It means that actually you are, sorry, 1 to 500 for 1,000 account. Okay, this is 1,000. So the 1 to 500, if you divide this by 500, you get 2. It means your one, oh, it's actually 2, right? Yeah, okay. So your $1 only pushes $2. All right. So in a way, you can probably have very many trades, So the higher the number on the leverage, okay, the less riskier your trades will be. So if you do 1 to 800 and something, then it means you can take very many trades. Oh, by the way, the lower your number on the leverage, the fewer trades you can take. Okay, so if you start doing one, if you find that the 1 to 100 might allow you maybe to take 10 trades, all right. If you do 1 to 50, you'll find that now you will not do 10 trades. You'll probably do like 5. Okay, and as you do, okay, by the time you come to 1 to 1, you probably can only take 1 trade in $1,000 account. So I hope that point is clear. It means that right now I have advised all of you to actually do 1 to 100, which gives you a good balance, because for $1,000, depending on the broker, you can take anything up to about, I think, 20 trades, 20 or something, most brokers, or some even up to 50 trades. So, but see, with 50 trades, it means even if the market was to go against you, 50 divided by 1,000, it's like at least you can do 20 trades, sorry, you can do up to, okay, I don't know how many that would be, but the point is, this number 1 to 100, as the number decreases, the higher your risk, and you do not want that. All right, I hope that's clear. Any questions? Thank you. That was Elsie, right?
Elsie.
Yeah, thank you. All right. Is that clear to people?
Yes.
Okay.
Yeah, Tom, if may I ask something?
Yes, you can, please.
You've always said that that trend is your friend.
Mm.
That if the general trend is bullish,
Yes.
then you should always be trying to trade bullish.
Yes.
But it seems you trade both ways, when it's going down, when it's going up. And
Yes.
you're saying your success rate is 95%.
Yes. Yes.
I'm just wondering whether you're trading on the same market or not. But otherwise, because sometimes when you want to do it both ways, you find that you're making a lot of losses along the way if you don't stick to the trend.
Yes.
I don't know what comment you can put on that. You can say on that.
Okay. Again, like I said, I am a scalper, hence my strategy is a bit different. In fact, if you watch me trade, I don't know if you've watched me trade. If you watch me trade, I do some very strange things. Let me see if I can do some things here. So if the market is going up like this, okay, so right now it's going up, all right? And maybe this was the last high, and that's the other level, right? So you'll find that, okay, and it has a like a general downtrend. It's not very clear, but so this thing is still going up. You'll find that uh, if you look backwards in a smaller time frame, this here are almost other support and resistance lines, smaller ones though. Okay, so as this market, okay, should have used, okay, as the market goes up, I look mostly, my trades are mostly from this level to that level. Then when I get that, I bank those profits. Then I'm trading from this level to that level. When I get those pips, I bank them. Then I trade from this level to that level. Then I bank them. By the time it's getting up there, see, most people trade the long haul. They're like, okay, I'm doing this from here to there. Because the market will not just go straight from here to there. No, it will come like this. It will go like that, down, up, down, and then consolidate, then up, down, up, down, consolidate, and then up, down, and so on and so on. So this, to me, those sessions where it consolidates and so on and so on, again, it's a chance for me to try and reevaluate the direction or what it's doing. So that you find that by the time we are starting again from there, I know where it's rallying to go. It wants to get up here. Okay. So I don't know if I've gotten off track with your question, but I try to break down my trades into small chunks so that I can manage them. I can actually maximize my pips. Because if I know that the market is rallying to reach that point, so in mentally, I can divide this into, for lack of a better word, 100%. So I think the market, if the market has good volatility, chances are at least it will reach 50%. Okay, by the time it reaches 60%, then it's losing momentum. I don't know if it'll reach there. But the first few trades from here to there, I really maximize them. I enter like there's no tomorrow. Once I get my profit, I wait, then I enter again. But then when it starts getting here, I start being cautious. So I think I may have gone beyond your question. Let me do something interesting. I need to stop the recording because it will be too long.